Look at it this way. Whatever it is, 5%, 10% pay 50% of all taxes in the U.S., something like that. You've really got a bifurcated economy. You've got those that are under pressure, have been under pressure for a couple of years now in terms of rising prices, in terms of wage growth being flat, not matching it, and in terms of, I'd say weak, very weak job growth. They're going to continue to be under pressure. So the question is, can the other part of the economy that accounts for most of the spending, can they bail out the economy? And how important is it to have those that can't in terms of what we're looking at? I think it's important, but they're not going to be focused on. So my view is the market's kind of toppy now, but I see no reason to sell.
Well, I think that's a great question, because if you know anybody that's an accountant, a consultant, a lawyer, AI is disrupting things. Consultants especially, I hear from them. Engagements are making a lot less money right now, and a lot of other industries in the white-collar areas, they're being disrupted.
Graduates can't get jobs,
I mean, that's entry level, but you're talking about the high-end income earners. Those are the people who are doing a lot of the spending. Their jobs are being disrupted as well. Jim, you're in the unenviable position of listening to what everybody else has to say and kind of giving your opinion. What do you think?
Very patient man, by the way.
He's very patient, very patient and very calm.
Unusually today.
Anchor man.
He is the anchor man.
Is there something coming up this week that you think that could derail this rally, that could change sentiment in the market and shift investor dollars away from tech and other areas with a lot of growth, maybe back to defensive trades like staples? Keeping in mind, we do have gold hitting an all-time high this week.
Yeah, so I've got two different perspectives here. And the first one dovetails with your question, which is you said this week. I think the risk this week is that actually nothing's really going on. Yes, you got Oracle earnings tomorrow, but at this point, the earnings picture in a backward-looking sense is already in place. As far as CPI, PPI, yes, it matters. Of course it matters. But it would have to be pretty dramatically hot to turn the Fed away from rate cutting next week. So I think really what the problem is that this market, if it's going meaningfully higher, is going to rely on earnings growth. Bryn pointed that out. And we're not even into the pre-announcement season, let alone the third quarter reporting season. So this is kind of Dullsville as far as this week goes. And that could leave a little bit of room to the downside, as the buyers have really kind of outspent themselves, in my opinion, at this point in time. As I look forward past this week, as I look to the end of the year, there's a lot of things to like, including a Fed that's cutting rates, including profit growth, including deregulation. If you want to know what the one risk to my generally quite rosy outlook is for the end of the year, that risk is actually that the tariffs get overturned. Here's why. That will probably require a return of $150 billion of collected tariffs so far. That will require more debt issuance by the Treasury, putting upward pressure on interest rates. It will also be stimulative to the economy if that $150 billion just comes back into corporate America. That will be stimulative. It will probably put sustained upward pressure on inflation. And while the administration will find new rules, new statutes to use in order to implement those tariffs, that is actually a risk that I'm looking at. I think at this point, what we need more than anything is trade policy uncertainty, and the legal trajectory here looks like it might increase that uncertainty.
Certainly in the last several days, the retreat in yields is a significant story. It's a significant story for all investors. You have a 2-year, I believe, at its lowest level since 2022. The 30-year at 4.70. That's a 3-month low. And you've got the 10-year pressing towards 4%. I'm hearing a lot in the asset allocation world about investors that are saying, OK, I don't need to take the equity risk. I'll actually use high yield as an equity replacement as these yields continue to push forward. So you're beginning to get a little bit of a competition there, where
have you seen those spreads?
Fixed income is starting
high yield spreads.
Yeah,
I mean, it's looking more attractive.
No. High yield spreads
are as tight as
crazy.
Historically tight spreads.
That's what I say, because I mean, bonds actually had a negative return in September. That's what I was asking you in August, excuse me. But so you're saying that
overall for the year, though, it's been a strong year for investment grade, for high yield. Right. And what investors are now doing is the expectation is, if in fact you get lower yields, you continue to get that push towards lower yields, you want to have the quality in fixed income, owning investment grade, and potentially using it as an equity
Joe, if I may, and Frank, let me do this quickly. I mean, your point is well made about lower yields. Do bear in mind what's going on in France and the United Kingdom and several developed nations where yields are spiking right now. And they're spiking in response to fiscal conditions that are bad, budget deficits that are really bad in continental Europe. And what I was saying, and I am concerned about the tariffs being overruled for this reason, is that if our fiscal deficit situation gets worse, we could see those yields spike in a hurry here.
Yeah,
We'll still be the best house on a bad block, you know. If we have a lot more ability to fund our treasury than they do. So I harbor the same concerns, but I also think there's a positive to it. And that means that margins for companies will be going higher if we do away with tariffs.
So, Brent, I want to get you involved in this conversation. We're talking about bond yields. Are you agreeing with Joe here about, well, I don't want to put words in your mouth. You go ahead.
Well, I think that you have to think about if yields are coming down, like there doesn't seem to be a recession on the horizon. I get this like event that Jim is talking about. That would have real impact because Scott Bessent was talking about it this weekend. The Treasury would have to pay that money back. So that is definitely like an exogenous event that we'll have to watch. But I think that if you think about yields coming down, there's real estate. If you look at houses and total real estate in the United States, is about a $35 trillion asset class. It's well larger than annual U.S. GDP. And so if yields start coming down and you start getting actually a little bit of thawing in just the real estate market as whole, that is very positive for the economy. It's very positive for home builders. It's positive for Home Depot. It's positive for private real estate. And so I do think there's this silver lining of rates coming down if you're not having an event causing them. And I think that is also, you're also going to see that we haven't seen any impact from the bill that was passed, the OBBB that has passed. I think it'll take several months, if not going into 2026. And so if we can glide into 2026 with just the economy weakening but not stalling, I do think those stimulative natures of the bill, as well as rates coming down and what that will do to the real estate market, will be very positive for the economy writ large.
You know, it seems like we're talking about like it's already kind of preordained that we're going on a rate cutting cycle as opposed to just possibly one rate cut. Just want to bounce something off if anybody jump in. Morgan Stanley out with a note. Headline, choppy price action in the short term. They basically said with the Fed still focused on the potential for inflation and labor data weak but not bad enough. There's questions in terms of just how much the Fed can cut in the near term. They think that's going to lead to some choppy price action this month and maybe even in October.
I'm sorry, Steve, but real quick, I agree with that premise, and that's why the BLS revisions are important tomorrow. CPI on Thursday is important. Next week, you're getting a rate cut, but thereafter, I'm unsure.
Yeah, I mean, look, I think the base case remains 25 bips. However, I think you've seen a reaction in the market.
But the first of many, or just
bips.
one, and then we'll wait and see?
It's the first of many. But that's
well, what's giving you all that confidence? Because we're going to get two inflation reports that could be very sticky. Jay Powell was okay with 2.9 in the last PCE, but if we're at 2.9 here, what gives you the confidence they're going to keep cutting?
Well, let me give you the clarity by finishing my thought. My thought is the first of many, but the timing of the many is uncertain and will be dependent. You've got a race right now, and the race is the economy versus inflation. So if you figure that and it's how the Fed adopts tariffs in terms of inflation. If they think it's one and done, we've seen the worst of it, then they may be confident to go in successive meetings. But they want to get in front of a declining economy, which, talking to CEOs and talking to investors that are credit investors, they do think the economy is just continuing to decline. Right. Last quarter aside.
I mean, I'm looking at the estimate for core, 3.1%. The estimate for headline, 2.9%.
It's going to be a hot number. I think it's going to be a hot number this week.
Brent, I see you nodding. I mean, let's say we just come in line with these estimates. Do you see us on a rate cutting campaign after that, or is it wait and see and maybe wait and see for a while?
I think at this level of inflation, we're about 100 basis points too tight on the short end. But do understand that the Fed will want, as long as we're not in a recession, the Fed will want Fed funds to be above inflation by about 100 plus basis points. And so, I mean, I think that you have to read these numbers, and I think that's going to decide how many rate cuts we do. Chairman Powell's been really clear. They don't want to do this herky-jerky where they're raising, stopping like we did in the 70s. They want to go on a glide path. I think that glide path would be 2 to 3, and I don't think one number, but I do think we have a lot of unknowns. The tariff impact really, there's been a lot of studies that we really haven't seen the impact of that yet, and we'll start seeing it this quarter, next quarter, if it has been an inflationary impact. So I think we'll get one rate cut, and then, just the timing of the calendar, we should get 1 or 2 more, but I don't think we'll get a full 100 basis points until we get the all clear that the inflation from tariffs has truly been just a one-time event.